Meta just delivered one of its strongest quarters in years. So why did the stock drop after earnings? In this video, I'm breaking down Meta's first quarter results, take a look at the charts, discuss the three biggest risks to the business, and I'll give a one-year price target for the stock. Let's generate alpha. Meta absolutely crushed expectations this quarter. Here are the headline numbers. Revenue came in at $56.3 billion, up 33% year over year. Operating income was about $22.9 billion, with a strong 41% margin. Net income hit $26.8 billion, up 61% year over year. Earnings per share was $10.44, massively beating estimates. This is elite-level profitability, especially for a company this big. Meta is still a cash-generating machine. So what's behind these huge numbers? Advertising is still king. Meta makes over 95% of its revenue from ads, and AI is making those ads smarter and more effective. Meta is using AI to improve ad targeting, content recommendations, and user engagement. Now here's the catch and why the stock fell. Meta is going all in on AI, and it's expensive. The capital expenditure forecast was raised to $125 to $145 billion for 2026. That's a massive increase driven by data centers, AI chips, and infrastructure. Investors are worried this could hurt margins long term. Another thing investors are watching closely: daily active people slightly declined to around 3.56 billion users globally. Some of this was due to geopolitical restrictions, but still, growth slowing is something to keep an eye on. So overall, a massive quarter with a couple things that spooked investors. Let's take a look at the charts. Right now, Meta is trading below its 50-day moving average, which sits around the $630 level. This tells us short-term momentum is weakening. When a stock drops below the 50-day, it usually means buyers are stepping back and sellers are starting to take control. Meta is also trading below its 200-day moving average. This is a big deal. The 200-day moving average represents the long-term trend, and being below it suggests the stock is under pressure overall. We're also seeing the 50-day moving average sitting below the 200-day. Historically, this is a bearish signal. It tells us that downward momentum is starting to build. It doesn't mean the stock will crash, but it does mean rallies could get rejected at key levels. Meta's relative strength index is sitting around the mid-range, roughly 55. It's not overbought and it's not oversold, so there's no extreme signal here. This tells us the stock is likely in a consolidation phase, not a panic sell-off, but also not a strong uptrend. Here are the three biggest risks that could meaningfully impact Meta shares going forward. The first and biggest risk right now is AI spending. We're talking over $125 billion per year. And here's the issue. No one knows exactly what the return on this investment will be. Yes, AI is improving ads and engagement, but the costs are exploding. So investors are asking, will Meta turn this into profit or just burn cash? Because if these investments don't pay off quickly, it could start to compress margins and hurt earnings growth. Meta is still heavily dependent on advertising. Over 95% of its revenue comes from ads. That's a huge concentration risk. If we see an economic slowdown, businesses cutting marketing budgets, or increased competition, Meta's revenue could take a hit fast. The third risk is user growth slowing down. Meta already has billions of users globally. That sounds great, but it also means growth is getting harder. Markets are becoming saturated, and younger users are shifting platforms. Apps like TikTok are pulling attention away, especially from younger audiences. If engagement drops, ad revenue eventually follows. So even small declines in user growth can have a big long-term impact. Now, the big question, where could the stock go from here? Most analysts maintain a buy rating with an average price target of about $837. Looking at the discounted cash flow model, the base case estimated value for the stock is about $700, and the best case is $1,262. As for my opinion, I am maintaining my buy rating with a 1-year price target of $1,000. Here are 3 reasons why I believe it's a buy. Meta is still growing at a pace most companies can only dream of. Revenue is up 33% year over year. Operating margins are above 40%. Billions in quarterly profit. This is not just growth, this is high-quality growth. Meta is doing this at massive scale. That kind of dominance is extremely hard to compete with. Meta's core business, advertising, is still printing cash. Tens of billions in free cash flow annually. A strong balance sheet with huge cash reserves. Meta has one of the most powerful advantages in tech: massive user data, best-in-class ad targeting, and global reach. This creates a self-reinforcing ecosystem where advertisers keep coming back. Even if new ventures take time, the core business funds everything. This is the big one: AI. Yes, Meta is spending heavily, but that spending is already improving ad targeting, engagement, and monetization. Ad impressions are up 19%, driven by AI improvements. And here's the opportunity. Meta isn't just building AI for fun, it's embedding it directly into its revenue engine. Better AI equals better ads, which equals higher revenue per user. Bonus reason the stock is a buy. Meta is trading at a lower valuation than many big tech peers. A forward price-to-earnings ratio of 18.51 is dirt cheap. The market may be underpricing Meta right now. So here's the takeaway: strong growth, massive profits, a dominant advertising business, and huge AI upside. Yes, there are risks, especially around AI spending, but that's exactly why the opportunity exists. So what do you think? Is Meta a buy-the-dip opportunity, or are you staying on the sidelines? Drop your thoughts in the comments. Thanks for watching. If you enjoyed this video and want more earnings recaps with 1-year price targets, please like and subscribe. Until next time, keep earning, keep saving, and keep investing. I personally own Meta shares. This is not financial advice, just my own opinions. Make sure you consider your own risk tolerance, time horizon, and financial situation before making any investment decisions.